Milton.com.
California headline news: another day of frigid temperatures in the Northeast and Midwest, resulting in tough times for air travelers. At SFO, spokesman Doug Yakels says most passengers are still eventually getting to their destinations.
This is a very light volume time of year for us at the airport, so if airlines can cancel one flight and combine it with the next flight, that reduces the delay effect overall. So I think that's what we're seeing in Chicago right now.
Meanwhile, rain is the concern here in California. That wet weather that's been hitting Northern California is spreading south, with up to 4 days of rain expected in the region, prompting those who live in the burn-scarred areas like Malibu to do their best to protect their property.
Now I'm just kind of sitting and waiting and hoping it's not a heavy downpour in a short period of time.
Mandatory evacuations underway in the Holy Fire burn scar due to the impending storms. Officials say those in the Amorose, Glen Ivy, Horse Chief, McVicker, Rice, and surrounding areas are urged to leave their homes immediately. The rain expected through Saturday in Northern California, possibly to Monday down south. Jeff Scott, California News.
At AT&T, we believe that access to affordable home internet brings incredible opportunities. Explore a digital world of possibilities and connect with family, friends, and the things that matter most. That's why there's access from AT&T. If you are a California resident and a member of your household participates in SNAP or receives SSI benefits, you may qualify for home internet at a discounted rate of $10 a month. No commitment, no deposit, no installation fee. Plus, get an in-home Wi-Fi gateway at no extra cost. Call 1-855-220-5211 or visit att.com/aware to learn more.
SNAP refers to the Federal Supplemental Nutrition Assistance Program. SSI refers to the Federal Supplemental Security Income Program. Pricing excludes taxes and fees. Service will include a monthly data allowance depending on the type and speed of service you receive. If you exceed your monthly data plan allowance, you will be automatically charged $10 for each 50 gigabytes of data usage in excess of your data plan, even if less than 50 gigabytes is used. For details about data allowances, go to att.com/internet-usage. Wi-Fi enabled device required. Other restrictions apply.
It's time to join the Tahibo Tea Club. Tahibo tea comes from the inner bark of the only tree in the world that fungus does not grow on. The Tahibo tree never gets sick, never gets infected, and never gets infested. As a result, it contains antifungal, anti-infection, antiviral, antibacterial, anti-inflammation, and anti-parasite properties. Tahibo tea can truly be miraculous for someone fighting a potentially life-threatening condition due to infection, diabetes, or cancer. Tahibo tea is available for only $34.95 per pound plus shipping. 1 pound makes 300 servings, which is only 12 cents per cup. Dial 818-883-7222 or buy online at drinksupertea.com. All orders ship immediately the same day. Call now, 818-883-7222. That number again, 818-883-7222 or buy online at drinksupertea.com.
Thank you, Inland Empire, for listening to KCAA Radio.
And now, ladies and gentlemen, it's time for the greatest real estate investment show ever. Here's the flip-flop investor himself, Todd Bayer.
Oh, hey everyone, how we doing out there today? This is the Flip-Flop Investor Show, and I am your host, Todd Bayer, the Flip-Flop Investor himself, coming to you live out of Redlands, California. I was about to say Riverside. We're coming to you from Redlands, California, from the KCAA studios. Every week, we like to get together and talk to other real estate investors about what they do in real estate investing, and I like to bring on a guest every single week to talk about what they do. This week, we have a repeat offender, the CLO of Rehab Loan Group. How you doing today, Ryan?
I'm fantastic. How about yourself?
Doing pretty good. You know, we were craving some Raven today.
Hey.
Ryan Raven. Yeah. Let's tell the folks a little bit about your background in real estate. You got started
very early. I started when I was 18. My dad was a real estate broker in Riverside.
Okay.
He had a brokerage with about 150 agents, somewhere in that neighborhood.
Oh, nice.
You know, flexing here and there. And
handling
he had a little bit
sales and all that.
Doing sales, and he had an escrow company and some other auxiliary management company, stuff like that.
Right.
And then he decided to start a mortgage company.
Okay.
And when I turned 18, he's like, "You're going to learn this whether you like it or not. What do you want to do?" And I said, "Well, sell money."
Yeah, exactly.
So
I mean, you wanted wanted to be in a rock band back then, right?
Exactly.
Yeah.
I had the long hair and everything, and I was ready for the rock band, but that didn't work out since I didn't know how to play an instrument, and I couldn't sing a tune. So I mean,
that's a problem. Yeah, you got to have at least one.
I
of
had
those
some
talents.
obstacles.
So starting a mortgage company back in, what would this be, like in the
98?
80s? 98, okay,
90,
so
98, 1990, kind of in that era. And we started off, he got a little credit line over at Inland Empire National Bank.
Okay.
And lent money out based on that credit line.
Okay.
On hard money at 18% and 18 points.
Sure, which was pretty typical
pretty
back
typical
then.
way back then. And, we bought and sold notes. We would advertise for seller carryback financing, buy it at a discount, and sell them off at to some insurance companies and stuff like that.
Okay.
And that's kind of how I got an introduction to lending and how lending works. So
Yeah. So when you were doing lending, were you also doing like the traditional, conventional style lending?
I didn't do that for probably about a year and a half, and then he had brought in somebody else to expand the mortgage company that was very familiar with more traditional type loans, and
Okay.
I learned a little from there. And then the market crashed, and back then, and
That was about 94.
Somewhere in that neighborhood. It was the early 90s.
Yeah.
And so then I went out and started learning how to be a real loan officer, doing FHA, conventional, and that kind of stuff, and worked for a few brokers, worked for a couple of banks, and went into the subprime business for a number of years.
Right.
That was
before the crash that just happened recently.
Yeah. back when it was stated income, and
Right.
the 7-Eleven worker was making $15,000 a month, and
Yeah, hey.
you're scratching your head, going, maybe I'm in the wrong business.
I know, yeah. Wages have really gone up. I should be a janitor making
Right?
$20,000.
No, the good one was the architectural landscaper who was making $20,000 a month. That was real common. So,
Those were all those multi-million-dollar landscape contracts he was working on.
Yeah, exactly. all the county and federal contracts that he had,
Right.
supposedly.
Yeah. So I'm guessing that guy didn't keep his house.
No, I don't think so.
No, bummer.
No.
That's funny. We bought a house from a guy that was a landscape architect.
Okay.
We had lost it in foreclosure.
Okay.
I don't know if it was the same guy or not, but
It could have been.
It could have been. Was it out in?
There were several that we did, so it could have been one of a dozen.
Yeah, who knows? We'll talk off the air on where
Right.
all the to keep the names of the innocent or whatever. I don't know.
Right.
Anonymous.
Right.
I don't know but
Something along those lines.
so basically, you've gone through, like 2 real estate crashes.
Yeah.
Which for pretty much any real estate investor, any real estate person, that's enough experience, I would say, to know how to mitigate yourself in any market.
Sure. You can kind of see it happening, and everybody kind of gets that feeling and that gut feeling. And a few years before, I was just thinking to myself, God, if everybody has to go stated to afford something, there's something wrong here,
Right.
There needs to be a correction or something.
Right.
So,
But as long as there's a lender out there putting money out there, you'll help them put their money out on the street. Yeah.
That's what selling money is all about.
Exactly. And so, it's ultimately, and there was a huge debate, especially I remember this most recent crash. It wasn't as much of a conversation in the 90s because we didn't drop as much, value as we did in the 2007 crash.
Yeah.
But I remember the discussion in 2007, 2008. It was the whole who's to blame thing,
Right.
And some people were quick to say, oh, it's the loan brokers, oh, it's the appraisers, oh, it's the real estate agents, it's all these different people that are responsible for inflating property values and forcing deals to go through and having things kind of cut through the gray areas of things to make them happen. And
Sure.
Looking back, would you be able to pin it on any single industry or person or anything like that?
I don't really think there is. It's just accumulation of all the little things that kind of happened, and when things are rolling along, nobody wants the music to stop. So, it's like,
it, yeah.
we're seeing a little problem here, so let's throw more money at it. That'll
Right.
fix it.
Yeah.
So, and of course, Wall Street's more than happy to play along, in those kinds of games.
Sure.
And, right up until they start losing money, and then they start pulling it all away, and the rug gets pulled out from underneath everybody. So
Yep.
that's kind of what I saw happen over there in the last downturn. Wall Street was just so hot and heavy, over getting their money out there and making those good, solid returns that they were making.
Right.
But they were too busy putting cheap money out there. They weren't pricing in for risk. I think that was one of the big issues that we saw, because you had these subprime lenders that were trying to compete and get volume that Fannie and Freddie was had, and just to be able to do that with a subprime loan, there's bound to be a problem at some point, because there's a reason why you build in, the pricing for risk, and why somebody with poor credit or no down payment or all these other things, pay a higher interest rate.
Right.
They,
one loan. And all that.
Yeah, you think of it. Oh, well, it's just one loan, and okay, so they foreclose after within 6 months. So how much are they really losing? But one loan is the equivalent of 20 to 30 loans. One bad loan is the equivalent of 20 or 30 good loans.
Right, exactly.
So it's not just that one that they're losing on. It's a big hit.
Yeah, and of course in their world they can't just break even.
Right.
They have to provide a yield.
Yeah.
You saw the movie The Big Short, I'm sure. Okay,
Yeah.
so in that movie, I know that they were alluding to the fact that it was the credit rating agency, or not credit rating, the ratings agencies like Moody's and I can't think of the other one right now. Anyway, those companies up there at the top, where here's these mortgage banks putting together these big packages of loans and saying these are all paper. They've called it a tranche. It's a package full of mortgages. And it's probably 1,000 that are all scattered around the whole country. And they say here's this tranche we're putting together. The average yield on this is going to be X and so forth. And they put it out there, and then the Moody's agency will give it a rating and say this is an A+ rated portfolio of mortgages. Right. And they put it out on the Wall Street open market. Everybody bids on it and buys it. And then there's these other things, these collateralized debt obligations, these other things, and I'm sure I'm going over most people's heads out there. But if you watch The Big Short, I think they do a fairly good job explaining it.
They did.
But it's this whole compliance / negligence across the board, where every single person in every part of the whole thing was not necessarily in on it, but they all were just sort of keeping the thing going.
Right.
And I don't know. I don't feel like you can blame any one particular person.
No.
You know,
you could point the finger at Wall Street. You can point the finger at the subprime industry. You could point the finger at borrowers that were, lying on their applications, or brokers that were helping these borrowers get into loans and not explaining the terms and those kinds of things. But I think everybody had their part in it.
Yeah.
During that time, and
nobody
wanted the music to stop, because the Joe Blow consumer was enjoying the ride, the equity wave that was going on, and they buy a house 1 week, and 5 months later it was up by 30% or 20%, something crazy.
Right.
And, you could refinance it right away and get rid of that PMI that because you only put 3% down, or you put 5% down, or nothing back then.
Right.
And then refinance
negative, get 110% financing.
Right.
I seem to remember. I remember one deal where it was like 125% financing somebody had gotten.
Right. Well, that was pretty popular, right? What was that? Late 90s?
Yeah.
Because I did a lot of second deeds of trust for, the 125 product, the 130 product. And, what was towards the end, there was 150% product.
That's
right
insane.
Before, the money store went under, and, and it started
the money store,
that problem. I can remember those guys.
Oh, yeah. I remember the commercials, Oh, man. Yeah. But you could, that's the funny thing about both of those markets when you compare them, is that at some point there became this crazy mortgage product out there that goes against all conventional thinking.
Yeah.
And right now we don't have that.
No.
And that's what's sort of weird about right now in the current market.
Yeah.
Is that everybody's feeling it. Everybody's saying something's going to happen at some point.
Right.
But we don't have anything crazy out there. And that goes for pretty much all consumer credit right now. It's not just mortgages. Like, car loans the interest rates are fairly high on a car loan, and they're still basing it upon, traditional kind of lending standards. And I think, I don't know. I don't necessarily want to say the government may have gotten it right with their with the Dodd-Frank and the RESPA and all the other things that came from that. I don't know if I want to say they did it right, but it certainly has prevented that loan product from coming into the market now.
Yeah, most lenders really got scared with the Dodd-Frank and and the procedures for having to foreclose and consumer rights and homeowners' rights, and everybody was like, well, if I don't prove the borrower can repay, then I can't foreclose, and then I lose my loan, and I can't foreclose and take back the collateral. Why do I want to get into that market?
Yeah.
Even though there's still, there's ways around it, and now we're seeing, the Alt A product kind of coming back, and the alternative products to the Fannie Mae. There's some lenders now doing almost subprime, but I would say smarter subprime.
Sure. Those are more on the private side.
Yeah.
Some of these larger hedge funds that are out there, some of these larger insurance companies that are out there that are playing in the mortgage world right now.
Right. Yeah,
but they can more or less do it.
This is the perfect time where you would normally in the normal markets in the past, you would have seen some sort of new financing to come into play. That kind of bridges or helps that consumer get into a house they can't afford.
Right.
And typically, or borrow against their house more than what they maybe should be.
Right.
That's what happened with the 125 seconds. That came in, and the mortgage volume slowed down right before that. And so here's a new product to spur the momentum again and get some more money out there and keep the market going. Same thing with the subprime products and the 100% financing.
Right.
It was, just a new product that they brought out right as volume started kind of coming down in the normal market. So, let's create a product that we can sell to, start, putting more money out there.
Right. Because there was plenty of housing stock, and, they needed people to buy it.
Right.
So, why not? We'll just put out a new loan product.
Sure.
But, I think right now, in the last crash, you'd go into a bank to go make a deposit or whatever you're doing at the bank, and there'd be ads all over the place for home equity lines of credit. You'd get approached by somebody while you're waiting in line. If you're interested in getting a home equity line of credit, then the teller would ask if you wanted a home equity line of credit. I mean, it was like every single person in the bank was there to sell you a HELOC.
Right.
And I don't have that now. Like, now they have a small little sign kind of in the corner of the bank that I see.
Yeah.
There's nobody in there asking me about a HELOC.
Right.
But it's there if you want it. They got it's available, but it's definitely not being pushed,
Yeah.
on the radio, on TV. I mean, I'm not seeing any kind of HELOC products on TV. I don't know if you've seen any.
Some, the HELOC products are out there, but they're not like what they used to be. Because, back in the day, shoot, you could get one on your rental property. On they'd go up to, 100% of the value or 90% of the value. These days, it seems like they're a lot more conservative. The big banks are still offering them.
Sure.
But, they're not going crazy like they used to.
Yeah. And there was, there was a lot of non-banks that were offering HELOCs, too.
Yeah. Yeah.
I think now you're kind of hearing this, what they call HELOC lookalike. I think I've heard of these people talking about.
Yeah.
People like Cash Call has like a HELOC lookalike or something. And, maybe it's not Cash Call. I don't know. But
I think it is.
Yeah. I don't know if I want to give them any free advertising, but and now for a word from our sponsor. So they have these products, like, they're out there, but they're just not, they're not that thing that's like, oh man, I could go buy another house.
Right.
Oh
yeah. People actually have to prove their income. That's the big difference between now and what it was. The inventory levels aren't what they were. There's not a high rate of foreclosures. I just read a report that I think the percentage of loans in default is at an all-time low. It's like 3.5%. And it's been that way for, ever
several
since,
years, probably 2014.
Yeah.
Yeah, it's probably been about the same, I think.
So, the lending practices are very safe, if not maybe overly overly tight, and you can tell because in a normal, credit market, they already expect to have, a default rate of somewhere between, 3 and 6% already. And so when you're on the lower end of it, that, everything in the credit market is pretty tight.
Yeah.
So
it's funny because we're working on a refinance of one of our properties, me and Steven, with our company, and we're working on a refinance right now for one of the houses. And, today I just provided personal bank statements, for not just the business, but for me personally, as well as Steven, and also a balance sheet for our entity, like all the stuff that I'm providing. And I'm like, I thought this is hard money,
Right.
I'm like, when did hard money start to look like conventional financing, and they ordered an appraisal, a full 1003 appraisal, like the, interior, exterior, they want the whole thing. Like, I'm like, when did hard money start looking exactly like a conventional lender where, there's an underwriter? Like, I don't remember there ever being an underwriter at a hard money firm, the underwriter was the guy I was talking on the phone with.
that private money that they talk about, that's always been, hard money is now institutional money. So
it really is.
Now they've gone in, and that's the new subprime these days, is the hard money, and these investors are looking for their returns. They know that they can get, 9-10% on their money on a regular basis instead of, it's been, I think I just saw a get 1.75 on your money on your savings if you lock it up for 12 months or
wow, that's a good CD. You're only losing 2% to inflation. No big deal.
Yeah,
But so some of these products, like looking at what the market, where the market is currently, versus like sort of like when the end of the road happens, there's that time period where I would kind of liken right now to about like a 2004, 2005 sort of feel.
Sure.
Where there's people in the market that are like, okay, pricing's gotten a little high.
Yeah.
Affordability's getting high, like getting lower and lower. Where less and less people can afford to buy the houses around here.
Yeah.
And it's, there's that feeling in the market, but those loan products aren't there. Like the answer hasn't showed up to this problem yet.
Sure.
And, there's not a lot of new home developments. There's some out there, but there's not as many as there were. I remember new housing developments were all over the place.
No, that's something that's changed over since the crash quite a bit. Builders, they used to go out and they'd buy the land, they'd, get all the permits, and they'd start building, 100 houses at a time, and they'll sell eventually, within this quarter or whatever. And now they're very cautious. Instead of building 100 houses, now they're, if they build the, more than just the models, it's usually pre-sold and then they build. And, that's kind of the new model this day, which is kind of
selling them off in much smaller phases.
The builders still being scared that they're going to get stuck with 100 homes like they did back in 2008. Sitting on the community of a ghost town now.
And I remember people back then buying houses in phase one or whatever, and they would buy them way before they were built, and they'd buy like 10 of them.
Oh, yeah.
And then they'd wait for phase 4 to finish up, and then they'd sell off those phase 1 houses, for $100,000 more per house. Some of these guys did pretty well doing that in the last cycle. But I haven't heard about anybody doing that this time. And they're also not building. I went to a new home development out in like the Mira Loma area. Out that way, there was one they're building out there, and they're only doing like 20, like in each phase, which is pretty small. It's a pretty good sized development, but 20 at a time is, I couldn't believe they're only doing that number of them.
Right.
And of course, they're practically sold out all the way through,
And that's designed on purpose so they don't get stuck with them. So, of course, they're pre-selling all those. So,
smart.
Yeah. It makes it a little more difficult to enter into a contract and just put a deposit down, wait for 6 months to 9 months, and sell that contract at a higher price, like what was going on back in the back in the heyday, so to speak.
Hey,
so.
I mean, it's still a model for people out there. I mean, it could work out. Don't do it because I said so, but do your due diligence always. But yeah, so you were kind of working in the conventional world back then, and when you did like the new tract development type stuff, were people coming to you for financing for that, or were you mostly dealing with people that were buying existing housing?
Mostly existing. I did a few of the new track builds as well, but most of the financing that I've done over my tenure has been when I've been in retail has just been direct to the consumer, and the consumer going out and getting a pre-approval and then going out and shopping and me doing the loan. I was in wholesale for a while, especially during the subprime days, and that was a completely different model. I was going to brokers and soliciting brokers that had the clients to send those loans over to us.
Right. You guys would fund sort of a line of credit for them, or how would you work that?
Basically, the broker would have a client. They'd go out and they'd shop several wholesale lenders and find out who had the right program for their client, and then they'd send the package over to us. We would underwrite the file. We would do the due diligence on the file and then fund that file. And sometimes we'd fund it in the broker's name, but most of the time we just funded it in our name.
Okay.
So.
And then you turn around and sell that off to Fannie Freddie.
Fannie Freddie, or back then with the subprime, we were selling it to Wall Street.
Okay.
Goldman and
Goldman Sachs,
yeah,
the Lehman Brothers, and yep, all those guys that we all heard about. Deutsche Bank. Yeah, well, they're still around.
Yeah, they are.
Yeah, they managed to make it through. In fact, I know that Deutsche Bank is pretty heavy in the hard money world right now.
They are. As a matter of fact, one of the investors that we work with, that is one of their funding sources is Deutsche. And interesting is that Deutsche has recently, at least with that investor, has pulled back some of the higher LTV, higher leverage products, and so they're getting a little more conservative. And you're seeing that kind of thing happening, where it's kind of funny. Kind of like right before the end, it seems like there's always a couple of guys that are getting a little more conservative and going, everybody's crazy, and then you got all the crazy guys out there throwing their money at it because they want to get in before it's too late.
Right.
And you see a lot of new money and a lot of the investors getting flush with capital to go lend.
Right.
And that's kind of where it feels like right before that 08 kind of timing, because you see some these hard money lenders that they're no longer private guys. It's not I've got a rich couple of investors wanting to make 10% on their money, and they invest in and buy these hard money loans or lend their money out directly to the consumer. This is now we're seeing the investment bankers are the ones that they're doing all the lending and providing the capital for all these hard money guys. So
sure. And I remember hearing something, this was a while back, and correct me if I'm wrong, but somebody had said that of all the subprime mortgages that were written during the 2004 through 2007 time period, that only 10% of those are actually the ones that foreclosed.
Sounds probably close.
Yeah.
It only takes a small percentage. It's surprising.
Yeah, to topple the whole thing.
Yeah, it's like I said, because you've got, not only are you losing the interest that you should be getting, but you're also incurring fees, through the foreclosure process and having to keep all the records and, and all of that kind of stuff, and then having to hire, an attorney and to go through the foreclosure process, and then, you've got to list it for sale, and, you got to, back then, a lot of the companies would, have to, do some minor improvements to the house to be able to recoup some of their money.
Yeah, trash them out. Yeah. Usually, I bought a few properties then, and yeah, you'd usually get them trashed out, but the rest of the house was destroyed.
Plus, you got to remember that a foreclosure. Everybody kind of expects to get a discount on a foreclosure.
Oh, absolutely, yeah.
So not only are you taking a loss on the loan, if you did that high leverage loan on that property that gets foreclosed, you're losing on that money. You're not recouping your original principal amount.
Your equity is getting
discounting it to 70%, 70 cents on the dollar, 50 cents on the dollar, and so
the house
taking that big loss.
The house that was worth $300,000, they did the loan for $300,000. Yep. Let's assume that we lost 30% of the market value in that area. You're now having to sell it for $210.
Yeah.
Which is $90,000 loss for the bank, and then 210 is what you're selling it for, but there's also those costs you incurred. You still have escrow costs, you still have title, taxes. I don't know if they were paying for insurance, but they probably should have been.
Right.
And then like you said, all the different fees for foreclosure that you have to pay. You got to pay for a variety of other things, commission, all those things you got to pay for. They're probably netting out of that thing 185, I don't know, something like there.
Sure.
So they're losing, nearly half of what they originally had in. So, for those other 90% of performing loans that were out there, which another portion of those got modified. Because there was sort of that mandatory modification program, or not mandatory, but there was that modification program
heavily
that came
encouraged by the government.
Right, exactly. And so they took some pretty big losses. But I remember, because I didn't know a whole lot about all the background stuff back in 2008. I just remember they're talking about bailing out the banks, and so many people were against it. But I don't think people realize how bad it could have gotten had that not happened.
It really was. As much as it seemed like they were bailing out the banks, they were really bailing out the everyday Joe Blow consumer and the U.S. citizens. I mean, you think about who are the guys that are the end buyer of those notes and all of those defaulted loans. It's okay. You look at it's Wall Street, but what's Wall Street's money coming from? It's coming from, the everyday Joe Blow's 401k,
pension plans.
The teachers' pension plans, the federal workers' pensions, all of those retirement accounts that everybody's expecting to, get a return on.
Right.
And, when all of those start going south and people start trying to pull out their money and then they can't because it's not there.
Right.
Then it sends out the shock waves and the panic, and so everybody starts to run on the banks. And that was, we were pretty close to people panicking and getting into a run on the banks. Even the ones that were profitable and were doing okay and didn't get into, the subprime lending.
Right.
Even they were, looking at, the fear of a run on the banks.
When B of A had to buy out Countrywide, and some of the giants had to basically step in and buy all this defaulted debt. You know.
Yeah, because if they didn't do it, then we were going to have a serious cash crunch where there was really going to be no money in the system to be able to get out from underneath.
Right.
And it would have been a pretty big disaster.
Yeah.
More so for the average, Joe citizen than it was for, Wall Street.
Yeah, and that's, of course, then we did all the quantitative easing through the Fed, which was probably also beneficial looking back. I remember at the time, it's kind of like, what? Why are we, why are we doing this? And then, interest rates, the federal funds rate going down to like 0.25%, the lowest it had ever been in history here anyway. But I remember their talks being like, where in Japan they had negative interest, where they were literally paying their banks to lend out money, just to stimulate the economy. It was, I remember that being the case. And, I feel like that was such a big crash, and they call it the Great Recession, but it was really like a mini depression. And I kind of wonder if it's going to be that bad again, for at least a while.
I just can't see it going back to that. We've just, like I said, the lending guidelines right now and the standards are still so high, the foreclosures are still so low, and there's not a lot of inventory out there. So, we don't have a lot of the things in the environment. Now, I think we will get back to, everybody. I think that people are panicking over something that is where we're going to a normal market.
Right.
Not, we're not seeing 08. 08 is still so fresh in everybody's head that, I think that there's that fear that we're going back there that could make things worse than they naturally would get. But I still think that we're going to be more in a normalized market. California, we've been lucky where, we go through these wild swings of appreciation and, 10%, 15%
year over year,
not unheard of, But, in a normal market, over the last 30 years that I've been doing loans, normal appreciation rates are between 6 and 8%.
Right.
Normal interest rates are between the same, 6 to 8%, somewhere in that neighborhood. We've been been what, almost 10 years of, you know, sub 6%, sub 5%
Sub
rates.
yeah, even sub 3 like at
You
one
know,
point.
I mean, hey, I've got a 3.5% rate on my mortgage.
That's not bad.
You know, I mean, when are we going to see that again? Probably not in our lifetime.
A bummer, because I'd love to see it again.
But I think we've all gotten really spoiled with those kinds of things.
Yeah.
And the fear of, you know, those rates going up, and, you know, I think has people kind of going, oh, the worst is coming again,
right,
kind of thing. But I think that, you know, we're going to see maybe lower than normal appreciation levels, but I still think that we'll still see appreciation.
Yeah.
You know, I don't think you know, some markets may depreciate, you know, or may lose some value, but I think those are going to be, you know, more isolated areas. I think that, you know, for the most part, we're just going to go down to, you know, 2-3% appreciation rates. You know, you'll be in a, you know, in your house a longer period of time. It used to be 7 years. Now it's like 12 or 13, I think I heard.
Yeah, for the average residency or length of stay, whatever you call it.
Yeah.
Yeah,
So,
people are moving more.
You know, people aren't churning the houses you know, like they used to. So, you know, I think that we're going to see a correction, but I think that correction is just a lower appreciation rates. I think that it's going to be harder in the future to, you know, hit home runs with flips.
Sure.
I don't think they'll ever go away, so to speak, because there's always going to be, you know, that person that, you know, that drug addict that can't make their payments, or, you know, that little old lady that, you know, is just done, you know, and has to go move into, you know, their kid's house, and the house is abandoned and run down, and the kids don't know how to fix it up. And there's always going to be that discounted house that somebody can pick up and, you know, flip, you know, for a profit.
Right.
I think that's going to happen in any kind of market. It's just going to be a much smaller percentage of the transactions.
Yeah.
I think we've really gotten spoiled with with the fix and flip market over the last you know, 10 years. So,
but that, you know, that starts to happen too. You know, like where I mean, I've heard people in 2009 saying there's no deals out there, and I'm like, you got to be kidding me.
Right. Yeah.
Like, walk outside, there's deals everywhere in 2009. You know, I remember people saying that back then, and then but people are saying it now, and I don't necessarily agree with them entirely, because there's still deals. There's always going to be deals to be done, but you know, the margins are getting lower. You have to be willing to make a little bit less on the deals that you want to do, and you know, like especially if you want to do volume. If you're good with doing one deal a year, you can hold out for that, you know, that grand slam. If it's not a grand slam, then just wait for the next one.
Yeah.
But you know, for the people that want to do a lot of deals, you know, you're gonna have to cut your margins down a little bit. You know, where 15% cash on cash was pretty easy to get from 2009 till 2016, but you know, now we might have to cut it down to about 10% if you want to get that, and you know, that's a little bit riskier for me. You know, like a little too risky for my blood, because I don't want to get into a situation because 10% can get eaten up pretty quickly.
Yeah.
You know, on a bad deal.
Right.
So you know, like I mean, just for example, we just had a property where we did you know, we're in escrow to close to sell the house, and you know, we call it a septic tank company, and they oh no, it wasn't septic tank, it was a sewer company, because we had a slow draining, you know, drain in the house.
Right.
So you know, they put the camera down the line, and of course they see there's an area where the pipe had sort of separated, you know, so it wasn't draining properly. We had a big blockage there, and plus some roots and things that had gotten into the pipes over the years, and it cost us $7,700 to you know, fix this issue, because it was a pretty long pipe. You know, they had to trench out some concrete. It was, you know, it was a pretty extensive piece of work, but you know, that's a $7,700 expense that we didn't expect to take on when we bought the deal.
Yeah.
You know, so it just lessened our profit quite a bit.
Right.
But if we already started at a lower starting point, that would have been a much bigger hit. You know, and so. Those types of things are what concern me when I get into a deal, and that's why I'm less willing to take a bad deal or take a deal on a lower margin, because I don't want to get stuck with that kind of a situation, because there's nothing worse than doing a deal and in the end making nothing.
Right. Or having to take a big loss.
Yeah,
I mean,
big loss.
I was just
is
talking
worse.
with an investor that said that they, you know, they hired a bad contractor, and you know, I mean, they basically had to go in, and all the work that he did, they had to redo. So they had to pull it all out, and they had to So
I know this investor.
Yeah. So I think they took a pretty big loss on that one.
Yes, they did.
And that can hurt, especially if you don't have the financial backing or the capital to keep it going. I mean, that could just devastate you. I mean, get you right out of the business if you're not not careful.
Talk about how many deals you have to do to make up for a loss like that.
Right. Right.
So yeah, it's tough out there, and but somebody else asked me the other day too, like what sort of a like if we were to crash today, like if today we were going to crash and the market was going to start going down. I mean, it doesn't really look like a crash today,
Right.
If we crash today, we're looking at a 5, maybe 10% tops, like depreciation in some of the higher it would be almost a non-event. It would be as bad as it was in the 90s,
Right. Exactly.
In certain areas. In some areas in the 90s it was worse, but there was it wouldn't be that bad. But if prices keep going up, if interest rates start going up, there are some things that would cause it to go a little bit lower. But I don't see a big crash happening.
No. I think the runaway appreciation is a thing of the past, and you're seeing investors at the top the market starting to get very conservative and pulling out of those high end spec houses that you see on $1 million listing. That product's starting to get taken away and much more restrictive now. They want much more capital into those kind of deals, but they're still flowing the everyday Joe Blow, fix and flip, $100 to $700,000 all day long,
right?
And even getting more aggressive with some of those guidelines. So
yeah, there's plenty of people out there that are still buying homes right now.
Yeah.
I was golfing yesterday, and I was playing with a pediatrician. He was one of the people they paired us up with.
Okay,
guy's a pediatrician, young guy, just finished residency. He's in his mid-20s, late 20s. And he, he's asking me, like, is now a good time to buy a home? And he's living out in the Orange County area, South Orange County. And, I'm like, well, I mean, what can you afford? Can you afford a home out in your area? Because I didn't want to ask him how much he made. I didn't want to get into those kind of details. But, I'm asking, like, what can you afford? Like, can you afford to buy these things? Because if it's for your own personal use, don't think of it like I would think of it. It's not like it's not an investment in the same way.
Yeah.
If you can afford it and you love the house, buy it. I mean, you're a physician. Your job's pretty safe.
Right.
You're probably going to have a job if the market crashes.
Yeah.
Now, if you're a construction worker, and you make all your money because you're building new construction, or you're doing maybe some fix and flip or home improvement type projects. I don't know. Maybe being a contractor wouldn't be such a great time to get into a home, because your source of income might dry up.
Right.
And I know we had a big issue with that in the Inland Empire last time, because construction made up like 20% of our economy.
Yeah.
So
we still haven't recovered from that. I mean, at least that industry.
Yeah, that's why a lot of people have moved into like the logistics space. Now we're at like 20% of our economy is logistics, and 20% of our economy is construction still.
Sure.
But like something gave. I don't know what gave, what went away. Right. But healthcare is becoming a bigger sector of our economy here. So there's if you're in one of those industries that could be affected by a recession, maybe now's not the best time to buy a house.
Right.
But
I think there's just different strategies now for it's different, going in and buying a home to live in. I mean, don't think of that as a quote unquote investment.
Right.
That's your house. I mean, you got to have a roof over your head one way or another. So if you like the house, you can afford the house, don't go thinking of it as your piggy bank.
Right.
I think that's been some of the problems over the years, and especially the way that mortgages get sold, because mortgages get sold that way.
Right.
Your house is an investment, and
you can take out a HELOC to do home improvement projects.
Like the Pick-a-Pay program that was popular for so long. I mean, for an investor, that was a great loan.
Of course.
Fantastic loan.
I'll pay zero.
Yeah, I mean, I'll pay negative. I'll let it negatively amortize and let appreciation catch up, because I'm going to get my cash flow right now, and that's what's important on a rental property, or something like that. So, for that kind of a person, that was beautiful loan. I did a lot of loans for investors with World Savings and WAMU on those kinds of things. But
man.
But if you're an everyday, you want to live in your house and you want to be able to, have it for a long time, that probably was not the best loan at all. Probably one of the worst loans for you to get.
Unless you planned on refinancing or selling within a certain period of time.
Yeah. And,
save your money in the interim.
Right. And then, you got, there was a product there for a little while that was kind of based on how the Australian banking system works with financing houses, and they were trying to really push the home equity loan. Mm-hmm. And so you would get this one equity loan, and you would use it as if it's your bank account.
Okay.
So you're just paying it down, and then you write checks against your house, and on that line of credit, and then you would just basically have your check deposited into that account. So your balance went down drastically, but as you're writing checks each month for all your bills, the balance goes back up. And it was kind of an interesting product, but
it is interesting. I kind of like it.
It never really caught on out here. But my opinion is don't, if it's your personal house, don't use it as a piggy bank. Don't count on appreciation. Who cares whether you're at 10% loan to value or you're at 100% loan to value.
Right.
If you can afford it and it's a good house and you like your house, who cares if the market goes up or down?
Yeah.
It's just the investor that you gotta worry about those kinds of things.
I think with like some of the websites that have come out since the last crash, you have like Zillow and Redfin and Trulia, Realtor.com, all these different websites will give you a value on your home. Yep. And so many consumer people don't understand how value works on a house.
Right.
And the value that you're getting from Zillow, your Zestimate, like some people will take that and say, like, oh, my house is worth, $400,000 because,
Isn't that what that's there for?
Yeah, Zillow said it was 400, and now all of a sudden the regular Joe Blow could look up recent sales activity. So now they're like, oh, Jane and Joe, they sold their house up the street for 400, so they're the same floor plan as us. Our house is worth 400, but we're forgetting that Jane and Joe had a pool and they had a $20,000 bathroom and kitchen makeover, and you're still rocking the old honey oak cabinets and tile countertops, and like you didn't do anything to your house. You have no backyard. You're not 400,000 because
not quite.
I think what a lot of people don't think about is that your house is only going to be worth what somebody's willing to pay for it.
Yes.
And there's probably a lot of people who have been through the foreclosure process that have seen that be the case, where the only person that can even actually buy it is an investor, because maybe it's in such bad condition that a regular buyer can't even buy it.
Right.
And I saw these all the time where people would go into escrow with a person who's trying to buy it with conventional financing, and then the appraisal would get done, and all of a sudden it falls out of escrow.
Right.
And then they'd then sometimes they'd make the mistake of doing it another time where they're still trying to get top dollar out of it, and sell it to a regular market buyer. Same thing would happen. Appraisal would happen. It would fall out of escrow, and then finally us as an investor would step in and say, we're going to buy this with cash or with hard money. And, then we'd finally close on the transaction and, we're off to the races. But we weren't buying it at the market price because it just was not worth that.
Right.
And it seemed like a lot of agents didn't really understand how the investor buyer worked, and we do our best trying to educate the agents on how investors work. We're not trying to take a discount. It's that we actually have to spend money on this place in order to get it back up to standards. Like we're actually improving the neighborhood. We're actually improving this house, so that it can be purchased by a regular buyer at that market price. But it's not worth that much, and it's not worth that much minus what the repairs are going to be, because we now have to do another escrow. We have to do the repair work. We have interest payments we're making to the investors and the the lenders and so forth. So there's got to be a profit element built into it too. Sure. It's I don't know of any nonprofit flipping companies out there.
Haven't heard of any recently.
Although I did know one lady that would sell one of the houses to her church at her cost.
Oh, really?
But that was like one house a year,
right.
because it's not a business model.
Sure.
You can't make your money on giving things away.
Well, not only that, as an investor, you're going to spend how many months on this project trying to flip it, and then if you spend 6 months on a house doing all the remodels and everything, and only make $5,000, that's less than $1,000 a month.
Yeah.
That you made.
Not worth your time.
So, I mean, and especially since you are not getting, you don't get paid typically on those until the escrow closes.
Right.
So you're
At the
just
very
spending money that entire time.
Yep.
So
that's where the investment side comes in.
Yep.
And that's what scares a lot of people off, because it's a lot of money at play.
Yeah.
And, unless you really know what you're doing, I mean, it can be pretty frightening.
Right.
So I think that's why we started this new group, this new meetup.
Right.
Through the Inland Empire Real Estate Investment Club.
I'm excited about it.
I know, I'm excited too. So we've had the Inland Empire Real Estate Investment Club. This is, it's now like the largest investment club by attendance in all of Southern California.
Oh, yeah.
And probably the best real estate investment community in the entire country.
The best.
But we've had that going for a while now, and now we've added new meetings. Now we're sort of we're going to have 4 meetings a month now.
Yeah, we locked up Wednesdays, huh?
Yeah, we are the Wednesday group. If you want to do something on a Wednesday night, we got something for you.
Right.
Except for if there's a 5th Wednesday in the month.
Yeah, that's
when
the
it
only
messes
Wednesday.
everything up.
Yeah.
And Steve and I were talking that on those months where there's a 5th Wednesday, we might do like a special 5th Wednesday party or something like that.
Yeah, I was just going to say, have a big bash.
We were talking because it happens only a few times a year,
Right.
So we've always talked. We always do the Christmas thing.
Yeah.
So we can't do that on a Wednesday. We always have to do that like a Saturday or something. But
Right.
maybe the summer party. Or I don't know. We were just kind of kicking around the idea, but. If we're going to do a party, it's probably going to be better to do it on like a Friday night or a Saturday rather than on a Wednesday, because we won't get anybody to show up to that.
Not at least for very long, not too late.
Yeah, exactly. Go till 9 o'clock,
Right.
But so we started this new meetup, which is going to be on the second Wednesday of every month.
Yes.
We'll be doing that also at the Mission Inn. We're calling this the Let's Make a Deal group, or we don't have a name for it per se,
right?
But we're just calling it like the Deals group or the Deals meetup or the Let's Make a Deal. I don't know.
I like the Let's Make a Deal kind of. I mean, that's a pretty good description on what it is. I mean, it's a great opportunity whether you're experienced or brand new, and you just you're not sure about your numbers, or you need somebody to double check, or those kinds of things. Bring the deal over, and we'll analyze it live right there at the meeting, and hopefully maybe even be able to find you some money for it.
Yeah. And basically, like most of the other meetings we do, like with cash flow is very educational.
Yeah.
It's fun and educational. The Saturday morning coffee is more networking.
Yeah.
We have the main monthly meeting, which is networking, and then we have an interview, which is where we really drill into somebody very deep on what they do, and then we're gonna have this one, which is the Let's Make a Deal. I think the purpose is really to focus more on the education side, on learning how to evaluate deals,
right,
to say, is this a good deal or not? And we'll take deals from all over the place, from your basic single family flip, or even a mobile home flip, or something like that, all the way up to if you got a multi-unit that you're trying to price out. We can run
LA 100-unit property that you want to analyze. We'll take a look at that too.
Exactly, and if anybody in the room has some money they're maybe looking to put into a deal or something, this might be a good place to partner up with people. And of course, before you do any of that, do your due diligence. Talk to your attorney, all your financial advisors.
Yeah.
We're not going to make any recommendations on any kind of investment there. Although, with you being the chief loan officer of Rehab Loan Group, I'm sure that if deals make sense, you'll probably be able to say, I know that we could do this as a lender. And those are things we're allowed to do as a licensed lender. But we won't necessarily be offering up any kind of partnership agreements or anything like that. That's going to be something people have to handle on their own still.
Absolutely. I
got to get
it's
the
a great way
disclosures.
because it seems like people go to the monthly meeting, the main meeting, and they're new, they're looking for that first deal, they're wondering how it gets structured, and how to quote unquote sell it or raise the money, and this is kind of that.
Exactly.
The meeting to go to learn those kinds of things, and how do you present a deal, and how do you make it to where it's attractive to somebody that has money, to invest into a deal.
Yeah, and if you're new into the because we see this stuff a lot. I mean, a new guy is going to stumble on a deal. It happens.
Right.
You're like, hey, I think you actually have a good deal on your hands. Yeah. My concern now is that you don't know what you're doing.
Right.
So do I really want to put my money behind a guy who's never done a deal before, especially because I was new once too, and I know exactly what I did wrong looking back on it. But, maybe there's a way in the room, because the way I see it, there's 3 sides to every deal. You have the deal itself. Whoever brings the deal, that's one side of the deal. Then you have the management of the deal. That's the person that's going to run the whole thing, get it from a piece of junk to a gem and sells it. That's the person that handles that side. Then you have the money. That's the third prong.
Yeah.
So the third prong can come from, hard money or somebody that has a bunch of money. They just want to put it to work. But I think teams of 3 often work best. And eventually you can eliminate that down to teams of 2, where the person finding the deal is also the person managing the deal.
Right.
And a lot of times the money guy is sort of on his own over here in his own little island with, his gold chains and, golden goblet that he's drinking out of. That's the money guy.
Right.
He gets the easiest job. He just has to give you the money.
He just has to, to go out there and just dole it out.
Exactly. He could be sipping Mai Tais somewhere, and we all want to be that guy someday. But,
exactly.
The manager and the deal finder, those are the guys that make the gears turn.
Right.
So, they're out there finding the deals. But, for the new guys, it would behoove them to work with a manager that knows what they're doing.
Absolutely.
So that would give the money person confidence in the deal.
Yep.
Because you can have the greatest deal in the world, but if you don't know what you're doing,
right.
It would be scary for me.
Sure.
And that's why a lot of these lenders that we're working with now that, we're putting money out on the street, their money, they want to see experience from the borrowers.
Right.
Because without the experience, they run into those issues. And when we were lending our money out before, when we were lending investor money out, we had a couple inexperienced borrowers that completely ruined the deals.
Right.
Sure. Had no idea what they were doing, went out there, and we originally said, oh, you should list it for, let's just say $250,000 when you go to sell, and they list it for $330,000, and you're thinking, why are you listing it for $330,000? Like,
yeah,
you're not going to
sit on the market an extra, 4 months while you're making all those interest payments.
Exactly.
And, incurring all the costs.
True story. It happened.
Yeah. Get in, get out.
And then you also go in, you're like, okay, the rehab you did in here was fairly basic and cheesy.
Yeah.
I could tell tons of stories, but the idea of this deals group is to get people to do deals live in front of the audience, and plus learn how to, evaluate deals, learn how to run comps, learn how to do all this stuff, because that's what people need to learn. So,
right.
Yeah.
It's going to be a great group, I think. There's going to be, there's already, dozen people signed up for it.
Yep.
And, we've got room for 50, 60?
50. Yeah, 50. We're going to have classroom style seating. So there's actually room for you to put a notebook down and write down notes and all that good stuff. And we'll have plenty of networking time and plenty of coffee.
Yeah. And that's only one day of advertising the deal too. I mean, hey.
Yeah, exactly.
So it's going to fill up pretty fast. I'm excited to be able to offer that education component, to the newer investors, and an open forum for the more experienced guys to help these guys understand and kind of
absolutely
make it a deal.
So I guess with that said, we've got a few other meetings. If you are interested in attending one of the Inland Empire Real Estate Investment Club's meetings, go to meetup.com. Check out all the different meeting dates we have on there. We're on pretty much every Wednesday of the month with all the different things we do. The first Wednesday being cash flow, second Wednesday being the deals group, third Wednesday is the Black Inland Empire Real Estate Investment Club, fourth Wednesday is the main monthly meeting, and the Saturday before the fourth Wednesday of the month is Saturday morning coffee. Just networking, getting together. So hope to see you all there. Go to meetup.com to check out that. And I want to thank Ryan Raven for coming on today.
Thank you much.
We'll see you all again next week, Thursday at 4 p.m. Have a good week, everyone. Take care.